In the last class, we had discussed about balance of payments and balance of trade, and now we are going to dwell upon the components of balance of payments. The two components of balance of payments are number one, current account, and number two, capital account. Under current account, we will be speaking about exports and imports of goods and services. We will be speaking about unilateral transfers, and we will be speaking about income, receipts and payments to and from abroad. We'll be talking about these under current account. And under capital account, children, we'll be speaking about borrowing and lending, we'll be to and from abroad. We'll be speaking about investments, again to and from abroad. So the next section is going to highlight these two issues. The two components are the current account, and we'll be speaking about the capital account, and we'll be explaining what are the components to be included and not to be included. And the questions you should be prepared with is the application oriented questions, which will help you to identify whether an item should belong to the current account or capital account. So the first component of current account is export and imports of goods and services. So these, when we are talking about export and imports of goods and services, we are talking about visible exports and visible imports. And the terms visible exports and visible imports mean the goods which have shape, which occupy space, which can be felt. So the exports and imports of goods are treated as current account. The second component of the current account is export and import of services. That means invisible trade. Under invisible trade, we will remember that what we did is SBI. So shipping, B stands for banking, and insurance. So any kind of payments made with respect to these will be recorded in the debit side, and any kind of payment which are received will be on account of these, that is shipping, banking and insurance, will be recorded on the positive side or credit side. The third component of current account is unilateral transfers. The other name for unilateral transfers is unrequited transfers to and from abroad. Anything going to, will be recorded in the debit side. Anything you are receiving from abroad will be recorded in the credit side. But please remember, these are one-sided transactions. They include gifts, donations, personal remittances, and we should not expect that something will come because you are giving. So these are one-way transfers from one country to the rest of the world, or from rest of the world to the country concerned. Any kind of payments you are receiving, any kind of unrequited transfers you are having, they will be recorded in the credit side, and any kind of unrequited transfers you are doing to the rest of the world, that will be recorded in the debit side. The last component of current account is income and receipts and payments to and from abroad. So this investment includes income from three sources: income from rent, income from interest, and income from profits. You can remember as RIP: income from rent, income from interest, and income from profits. So the first one is export and imports of visible goods. Imports will be recorded in debit side, exports will be recorded in credit side. The second one is regarding invisibles. Invisibles is your SBI, shipping, banking and insurance. So any kind of exports being made with respect to this will be in the credit side, and imports will be on the debit side. Unilateral transfers are one-way transfers, so if you receive, it will be on the credit side. If you are paying, it will be on the debit side. And income receipts and payments to and from abroad with respect to rent, interest and profits will be also a part of current account. Next thing regarding current account is we must remember that current account records all actual transaction of goods and services. Please remember this word. It is the actual transaction of goods and services which affect the areas of income, it affects the area of output, and it affects the area of employment, and these are a part of current account. So when we are classifying activities as current account and capital account, this again is a key word which will help us to identify whether the component is part of current account or capital account. Very often the examiner would ask you to distinguish between balance of trade and current account. So far we have done both these concepts, and we should be able to explain the differences between them. We have said that balance of trade is a narrow concept as it includes only visible items. So far we have just completed that current account has all the four components, so it includes visible items as well as invisible items. So the narrowness of the concept comes because there are only visible items over here. The wider concept comes because they are both visible as well as invisible items as components of current account. To explain the balance in current account, we can further explain the balance in terms of credit and debit items. So, if the net value of debit and credit items are equal, then there will be a balance in current account. However, if the credit items exceed the debit items, there will be a surplus in credit account. So this will lead to an inflow of foreign exchange. And the third eventuality is there can be a deficit in current account. Deficit will arise when debit items are more than credit items. So if we remember this concept of explaining the balance in terms of credit and debit account, it will be easier for us not only to understand but to retain the concept for lifelong. After having discussed the components of current account, we must also remember something regarding current account, that is, current account includes all those transactions that does not impact, either have no impact on assets and they have no impact on liabilities. That means they do not have any future claims or they do not create any future claims for the country. This is important for the application kind of questions. Let us take some examples which will help us to understand that all the components of the current account which we have studied, their transactions with the rest of the world, whether we are supposed to put them on the debit side or we are supposed to keep them on the net credit side. So if we take the first example, first component, visible trade, that is exports of goods. The imports wherein we have to make payments to the rest of the world will be recorded in the debit side, and if it is next exports, we will earn something in return, so it will be recorded on the credit side. Take the next component, that is invisible trade, which means exports of services, and we have done exports of services include shipping, banking and insurance. If you are importing these services, which means you are using the services from the rest of the world, they will be recorded in the debit side. If we are exporting these services, that means we are providing these services to the rest of the world, they will be recorded on the credit side. The third component of the current account is unilateral transfers, that means one-way transfers. Any kind of transfer payments, one-sided payments which are going from our side to the rest of the world will be recorded in the debit side. and any kind of transfer payment receipts which we are getting from the rest of the world will be recorded on the net credit side. The fourth component is income receipts and payments. The payments part, something is getting out from the pockets of the country to the rest of the world, so it will be entered under the debit side. And if these net income receipts are coming from the rest of the world, it will be recorded on the credit side. So in short, we can say that current receipts is a sum of visible trade, invisible trade, unilateral transfers, and income receipts and payments, that is income receipts. The second component of balance of payment account is capital account. And the key words to understand the definition of capital account or components of capital account is that BOP records all those transactions between the residents of a country and rest of the world. And here it is causing a change in assets and liabilities of the residents of the country or its government. So in current account we said that there's no change in assets or liabilities, but in case of capital account there is a change in asset and there is a change in liability. In case of capital account, the claims are in terms of liabilities. Claims and liabilities are of financial nature. Claims and liabilities are of financial nature, and this can be used to finance deficit in the current account, or it can be used to absorb the surplus of the current account. Since the claims and liabilities are of financial nature, so it does not have an impact of on income, output and employment of the country. So please remember the key terms. Capital account records all those transactions between the residents of the country and rest of the world which affects the assets as well as liabilities. To explain what are liabilities, suppose you take a loan from a country, your liability increases because you're supposed to pay that loan after a set period or agreed period of time. So capital account, all the transactions are of financial nature, but it does not have a direct impact on income, output and employment, unlike the current account. Now, what are the uses of capital account? So the first use of capital account is that it is used to finance deficit in the current account, and it is used to absorb surplus of the current account. So in other words, we can say that capital account is a stock concept, whereas current account is a flow concept. The three components of the capital account are borrowing and lending to and from abroad. This includes external borrowings and external assistance. Although they sound same, but they are not exactly the same. It includes investment to and from abroad and change in foreign exchange reserves. So if we have to explain what are external borrowings is when a country takes loan from other country at the market rate of interest. That is what is borrowing. But what is external assistance? Again, the loan is taken, but this time the loan is at a concessional rate of interest. This assistance word itself tells us that the loan is at concessional rate of interest, and in case of external borrowings, the loan is at market rate of interest. Borrowings and lendings to and from abroad has two components. One is to. So remember, to is you are sending something outside, and from, let's remember, we are bringing something inside. So what will be included under credit side? All those transactions, all those borrowings from the abroad, either by the government or the private sector, will be included on the credit side. And when receipts of such loans is done, or repayment of loans is coming back to us by the foreigners, by the rest of the world, such items will be recorded on the positive side of balance of payments of capital account. All those transactions which relate to lending to abroad, that means something is going from the country to the rest of the world, either by the private sector or by the government sector, or repayment of loans. Again, something is going from our country to the rest of the world. These items will be recorded under debit items or on negative side of the components of capital account. Let's understand the third component of balance of payment. Investment to and from abroad includes two things. One is investment by rest of the world in our country, and the second one is investment by Indian residents in foreign companies or foreign countries. So rest of the world investing in our country would be included in the positive side of credit account, and investments by Indian residents in other countries will be included under negative side of debit account. Let's understand this with the help of example, that is the credit side and debit side. For example, investments by the rest of the world, either they invest in Indian shares or they invest in the real estate in India. So when they invest in Indian shares or when they invest in real estate in India, these investments will bring foreign exchange in the country, and it will be recorded in the credit side of the capital account. On the contrary, if Indian residents, for example, an Indian resident makes an investment in the shares in a Dubai company, or they buy a house in Dubai, so such kind of investments will be recorded on the debit side of the capital account, because money is flowing from the country India to the rest of the world. It's basically leading to outflow of foreign exchange. So any kind of outflow of foreign exchange will be recorded on the debit side of the capital account. So we have done so far borrowings and investments to and from abroad, and our third component is change in foreign exchange reserve. It's very important to understand the debit and credit entries in the foreign exchange reserves account. We know that the sole authority which regulates the foreign exchange reserves in the country is the central bank of the country, and we've studied the structure of the banking system in the country. You have the central bank, and below the central bank you have commercial banks, and you have also the government borrowing from the commercial bank. So if government takes money from the central bank, it will be recorded in the credit side of the capital account, and if the government deposits money, that will add to the reserves of the central bank, it will be recorded on the negative side, that is the debit side of the capital account. So what we are trying to say is that withdrawal from reserves will be recorded on the positive side of the capital account, because money is coming into the account of the government, and addition to these reserves will be recorded in the negative side or debit side of the capital account. With respect to investments, there are two kinds of investments which can be made by a country in rest of the world and rest of the world in a particular country. The first category of investment is foreign direct investment. Second category of investment is portfolio investment. Now, what is foreign direct investment? In case of foreign direct investment, it refers to a purchase of an asset, and when you purchase this asset, it gives direct control to the purchaser of an asset. Suppose you buy land and building. So this land and building is in your name, and you have direct control as a purchaser over this asset. But what is portfolio investment? Portfolio investment is that you have invested in the shares of a company. Okay, so you don't have any direct control in case of when you are buying shares of a particular company. So what is portfolio investment? It just refers to a purchase of an asset, but this purchase of asset does not give you any direct control, unlike foreign direct investment. Foreign direct investment, you are purchasing an asset and when you purchase the asset, you have direct control over it. But in case of portfolio investment, like when you purchase a share, you have no direct control over the asset. Your control is only to the point of the shares which are held by you. This portfolio investment also includes foreign institutional investment. So to conclude about capital account, one more thing needs to be kept in mind, that export and imports of capital goods like plant and machinery equipments, they are to be included under current account under the head of visible items, and they are not to be included under capital account. Now balance on capital account has two subheadings, and these two subheadings lead to the third one, that is net value of credit and debit items, debit balances in the balance on capital account. So what is included in the credit or positive side of the capital account? This is just a repetition. Anything which leads to the inflow of foreign exchange. This anything is in terms of receipt of loans from abroad. When you sell an asset, you again receive money from abroad, or when you sell a share, again money comes into your account. So all these kinds of transactions are recorded on credit or positive side of capital account. So what is included in the debit or negative side of capital account, or which transactions are categorized under debit or the negative side of capital account? These are transactions like repayment of loans. So there's outflow of foreign exchange or purchase of assets, again you have to pay something in return, so that will be recorded on the debit side of capital account. Or you are purchasing shares in a foreign country, again you have to make the payment from your account, so it will be recorded on the negative side or the debit side of the capital account. And remember, the net value of credit and debit balances is what is the balance on capital account. In this reference, we will try and explain what is surplus in capital account and what is deficit in capital account. So how to know whether balance on capital account is surplus or deficit? If credit items are more than the debit items, there is more inflow of foreign exchange and there will be a surplus in capital account. On the contrary, if debit items are more than the credit items, there will be a deficit. That means there's more outflow over here, and in this case there will be a deficit in capital account. Here there is more inflow, and we have to account for errors and omission. This is a balancing item which reflects the inability to record all international transactions accurately. Just as we explained some terms for the current account, in a similar way we will now talk about the capital account. So talking about the first item, it includes borrowing from abroad. Second one is investment from abroad. Third one is decrease in foreign exchange reserves. So if you are lending to abroad, that means something is getting out from your country to a foreign world, so it will be included under debit item. On the contrary, if you are borrowing something from abroad, that amount will be credited to your account within the country. There is inflow of foreign exchange and it will be included in the net credit item. So why do we say net credit? Net credit is credit minus debit. The second one is investments from abroad. If you are investing in the rest of the world, okay, outside your country, such items will be included under debit items. And what is net investments from abroad? Net investments means what has gone from your country what has happened in your country, what investments have taken place in your country, and what investments have gone from your country. If you subtract them, you will get net investments from abroad. The next one is talking about decrease in foreign exchange reserves. So under the debit items, we will be including increase in foreign exchange reserves, and the net credit items we will be including net change in foreign exchange reserves. So if you add all these three, you will get capital receipts, and net credit is nothing but credit minus debit. When you calculate all this, you will get capital account balance. Just like as we calculated current account balance, in a similar way, we will be able to calculate capital account balance. Now, speaking about balance on current account versus balance on capital account, uh, kindly remember that both are interrelated. A deficit in current account, that means when your debit items are more than the credit items, must be settled by surplus on capital account. So anything surplus arising from the capital account can be used to suffice or to accommodate the deficit which has occurred in the current account. And a surplus in current account must be matched by a deficit on capital account. So this is how both are related. So if you have a current account surplus, you can match it by a deficit in the capital account. So if a question is asked how are balance on current account and balance on capital account interrelated, this is how you are supposed to explain it. Talking about the differences between the current account and capital account, current account transactions bring a change in the current level of a country's income, whereas capital account transactions, they bring a change in the capital stock of the country. This is how they influence the economy. The second thing we have already studied is current account is a flow concept, as it includes items which are of flow nature, that is the goods, visible goods, invisible goods, unilateral transfers. But on the contrary, capital account is a stock concept, as it includes items which express changes in stocks like borrowings and investment. These are part of capital account. If you are asked to sum up what are the components of current account, it is just a repetition again. It includes visible items, it includes invisible items, unilateral transfers, income receipts and payments. And what are the components of capital account? It includes borrowings and lendings to and from abroad, investments to and from abroad, and change in foreign exchange reserves.